All right, sir. So what we have to study today is cash flows. So for cash flows, if you could please remind me what we already know about cash flow. Okay. Okay. Excellent. Excellent. So we said that there is a formula to calculate cash flow, and that formula is that if we have some cash inflow, the business it would be doing activities, and by now we would have developed the intuition that those activities they result in some cash inflow, and from that cash inflow if I deduct the cash outflow, I'll come up with net cash flow. So cash flow as a broader term, it means how much cash it is moving in and out of the business, right? Acha. So for cash flow, if I had to define it, I'll say cash moving in and out of your cash flowing in and out of business, whichever cash in and out of business. Acha. The next thing that we must know is that this is net cash flow, and for net cash flow, we said that if we add to it the opening cash, we will get the closing cash. Acha. In the previous classes, I also mentioned that there are five statements that we make, and the set of these five statements together, it's called financial statements. So in financial statements, the three most important ones we said they were financial statements. There was statement of financial position, which was made as per the principles of accounting equation that assets are equal to equity plus liabilities. Then we have got income statement, a statement for profit or loss, which is revenue minus expenses is equal to either profit or loss. And the third one that we have is cash flow. So it varies from economy to economy and from market to market, but these financial statements they are prepared for different groups of people, right? The financial statements they are prepared for the owners of the business so that they are aware of what's the dynamics of the business, how are the different assets, where are they being funded from, whether the business it's being run profitably or not, and what's the cash position. Someone might say, and this happens in the markets where they place primary importance on the statement of financial position and income statement. One might say that what's the need of cash flow if I've already got the position of what my assets are, what's my investment in the business, how much I owe to people, and the profit that I'm making. The thing is, cash flow, for example, in the US market, in the Western markets, sometimes they place more emphasis on cash flow as compared to income statement. The reason is partly the nature of it and partly their experiences with it. What do I mean by that? If we talk about the nature, we have seen that there could be circumstances in a business where the business isn't making profit, yet there is cash inflow. Also, there could be circumstances where business is making a loss, yet there is positive cash flow. So, what do I mean by that? So, for example, let's consider there is a business which is making a sales of 100 million, and for that 100 million, they had a cost of 80 million, right? It means that they're earning a profit of 20 million. Fine. But the cash flow position is that the business 80 million. The people from whom I bought my goods, they insisted that I paid them upfront. So 80 million, there has been cash outflow. My customers, they are sort of, let's say I'm a new business, so new business making 100 million of sales sounds doesn't sound that credible, but let's say the currency is really weak, whichever currency we're talking about. Okay, so 100 million, the customers they haven't paid me yet. So my cash flow position for this business would be that even though I am profitable, yet there has been a massive cash outflow. This profit, it wouldn't be of much use if this situation persists. I won't be able to continue with this situation where I'm earning profits, but my cash flows are negative. Okay. So, okay. So you made a transaction. In this transaction, you sold something worth 100 dirhams, let's say. Okay. So when you sold this thing worth 100 dirhams, this thing had costed you 80 dirhams. So you have made a profit of 20. Acha. So this is the profit side of it. The cash flow side of this transaction is that people from whom you bought this good, which has costed you 80, they insisted that you pay them upfront because you're a new business, they aren't willing to give you credit. Okay. So you paid 80 dirhams, and people who are buying from you, they are saying that since you are a new business, we want you to sell this thing to us on credit so that we use it, and then if we are satisfied, we'll continue buying from you, or we'll keep the good, otherwise we'll return the rest of. Hmm. So the point that I'm trying to make over here is that this situation, if it continues for a long period of time, that I am running business in a profitable manner, yet cash flow is negative. At initial stages of the business, I might expect that I'll have to do it for some period of time. Maybe at a later date, when there is, let's say, economic turmoil, in order to encourage people to keep buying from me, maybe I'll offer them lenient terms. But this is not something that is sustainable. Okay. How many people will I give credit? Soon I'll run out of cash. When I run out of cash, what will I do then? So either I'll have to wait for the payments to arrive, or the situation, it could get worse to the extent that I'll have to wind up my business. Okay. This was, and the other reason, this is one reason. Another reason is that sometimes people, or the whoever is reading the financial statements, they say, we don't care what profits, I mean, we care what profits or losses you are making, but those profits or losses are meaningless to us unless they are translated into cash. So, for example, in the famous 2007 financial crisis, there were businesses which were reporting profit after profit, and they were selling very profitable products. But turns out those profits, they were booked just on the basis of accounting equations and assumptions. And soon, when the situation it turned south, they ran out of cash, and it got so worse that businesses which had been around for 100 years or above, even they had to wind up. Okay. So I'm saying, the point that I'm trying to make over here is that cash flows, sometimes they're equally, or at times even more important than the profit or loss position of the business. Okay. Acha. So we can't just ignore the cash flow position. We have to look at the cash flow position besides looking at the income or profits position of the business as well. So a few more terms to use over here that we'll be using. So perhaps now is a good time to understand these things. One is the term of liquidity. What does liquidity mean? Sir, liquidity means the ability of anything to turn into cash. Ability of an asset to get converted into cash is liquidity. The sooner an asset it can get converted into cash, the more liquid it is. For example, ability, I'll write it. Ability of an asset to convert into cash. Ability of an asset to convert into cash. So, for example, cash is the most liquid item. The cash, the currency that you're holding, the coins and the banknotes. After cash, one thing that is just slight bit less liquid, that would be your bank account. It's almost equivalent to your cash, right? Okay. Besides the cash and bank account, the next thing that you'll perhaps have is, it's mine. Just a second. It's an issue at my end. Now it should be fine. Is it? Can you hear me now? Okay. Okay, hopefully it should get better. All right, it's recovering. Somehow the speed it went bad. Anyhow, it seems to be fine now. So liquidity, we have understood what's liquidity and how we classify. So for example, land, it would take a long time to get converted into cash. You'll have to find customers, you'll have to negotiate price with them, you'll have to go through a lot of legal requirements right to the time then when it's actually sold and you receive cash for it, right? So land is considered least liquid of all the assets that you hold. Is my voice fine now or is it still lagging? Huh. I was saying that land perhaps is the most non-liquid item that you'll have on your balance sheet. And the reason is that it takes a lot of time to convert into cash. For example, finding the right customer, uh, negotiating the price with them, then negotiating the price with them, then getting through the legal procedure of the land to get it off your books and to get it on their books. So all this, it takes a lot of time. That is why when we draw the financial statements of a business, we usually draw in the sequence of non-current to current items. So land is placed right at the top. Can you hear me now? Okay. 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 Acha ji, this liquidity we have understood that liquidity of different items, it could be different. The other thing that we have to understand is overheads. So what are overheads? Overheads are overheads are operating expenses for a business. Okay. Operating expenses as in the expenses that are incurred by the business that there are two types of costs that a business incurs with regards to how that cost it can be attributed to different items that are being produced by the business. So for example, there are direct costs and there are indirect costs. Direct costs are the ones that you can and direct labor. These are direct costs. Okay, the workers who are making the beds, their wages, and the material that you're using to make these beds, this would be your direct costs. However, the for example, 1 second, let me in fact pause and restart because it shows that my connection is bad. Let me restart my system and let me check if that makes it any better. Okay.